Okay. Well, good morning, everyone. Happy Friday. All right. I think I see our face there. So we'll just give it just a minute. So if anybody's out there and anybody wants to drop in the chat, drop a question in the chat, maybe, or maybe hashtag coffee break. And then, yeah. Okay. I think we're gonna get rock and rolling and, hopefully everything is working. So good morning and welcome. Welcome to today's edition of the Construction CPA's Coffee Cafe. I'm Lisa Raish, CPA, aka the Construction CPA, and we're dropping the hammer on cash flow problems for one of these days I'll get my tagline correct. Sorry. We're dropping the hammer on cash flow problems for contractors with hands-off accounting services so you can build things that matter. And this morning's topic is going to be understanding the self-employment tax and how to calculate it. This is the type of self-employment tax can be a really big, can be if in your first years, many people go into business and they go in self-employed, sole proprietor. It tends to be the easiest. We talked about it, I think, a couple of weeks ago. It tends to be the easiest one to get started and get rocking and rolling and get in business. So it is important to understand because it can be a very big number. That first year that you file your taxes and you find out that you're filing as self-employed. And so you're basically, you're combining, you're paying the Social Security and Medicare taxes on your on your earnings, on what you've earned through your sole proprietorship. And so we'll walk through like what constitutes self-employment income, some of the deductions, how to calculate it. We'll see if I can share my screen and show you a little calculation that I pulled together. And so I don't know, we'll go from there. So again, if you have any questions about self-employment while we walk through this, please drop it in the chat. We'd love to try and answer any of your questions. So self-employment tax is basically the tax that is kind of, we'll say, I don't want to say levied, but it refers to a tax that self-employed individuals pay, or sole small business owners, let's call it that. That might be a little bit easier for people to kind of understand. You pay to the government. It's basically your Social Security and Medicare. And the best way that I can explain it, and the way that I typically do to clients, is when you work for someone else and you get that W-2 at year end, you are paying, or what is getting withheld from your paycheck is typically your federal income tax for most people. There'll be the Social Security, Medicare, or the FICA is what people call it. And then depending on what state you're in, is going to be a state withholding. And FICA or Social Security, Medicare are withheld at 7.65% from your paycheck. What the average employee doesn't know is that the employer is matching that 7.65. So there's a total of 15.3% that goes to the Social Security Administration on your behalf every year. And basically, when you are self-employed, you are now paying that entire 15.3%. So kind of keep that in the back of your brain as we walk through all of this, and just kind of remember it's not a new tax to you. It's just the way that it's kind of being levied or waged against you is different than when you work for someone else. Again, self-employment tax is not income tax. So when you are self-employed, or you're a sole proprietor, or you're filing a Schedule C tax return, or you're in a partnership and you're considered self-employed as a partnership, you are paying self-employment tax. So you're paying 15.3%. And again, we'll dig into that number a little bit. You are also paying income tax because you're paying income tax on the income you've earned. So again, you put those two numbers together, and if you're in business for that first year and you've made some profit, you've made some money, now suddenly that can be a really big number. So gets a little scary that first year. And so we'll talk about, how you can, do estimates and so on. We'll walk through all of that as we kind of move through all of all the material here. So again, we talked about, I explained to you the whole thing with, when you work for someone else. And I think that's the piece that most people don't understand. It's like, they think that they're suddenly paying this thing, but it's not new. You've paid it all along, or you've been paying into it all along. And you're basically paying into the Social Security pool that in theory will exist when you retire. I'm not a Social Security expert and I'm not going to dive into that, but in theory, you're paying into the pool so that when you do retire, there's money there for you to receive retirement or Social Security in your older age. So that's the theory and the idea behind what it is. So again, the benefits, Social Security, we all know what that is. That's in retirement, you get your Social Security income, right? It's what everybody is paying into. Again, you're paying into the big pool. So what are the tax rates? So for Social Security, so the first item, Social Security is 6 points. So when you are working for someone else, it's 6.2%, but when you are self-employed, it's the entire 12.4%. And that is taxed up to for this particular year, it's $160,200. The limits do increase on an annual basis. So again, for next year, it'll go up and it'll keep going up. And it's basically based on inflation, but that's where we are at this moment in time when we're recording this. And then you're going to have your Medicare tax. So the Medicare piece of it. And if you work for somebody else, it's going to be 1.5% of your salary that's withheld. And when you are entirely self-employed, it's 2.9%. So the two of them together, the 12.4% and the 2.9 become that 15.3% that I talked about in the beginning. So that's your total self-employment. So again, how is it calculated? It's really when you're a self-employed individual, it comes out of you either providing, personal services, or again, you have some sort of business income. It can't be classified as wages. You don't work for someone else. Maybe you've gotten a 1099 from someone else. Maybe you have a business where you're offering services, products, so on and so forth. So you don't have that employer-employee relationship. And because you do not have that relationship, you now need to pay the 15.3% yourself, instead of half being taken out of your paycheck, then half matched by the employer that you previously had. So when you are self-employed, again, you have the ability to take deductions against that income. They need to be ordinary and necessary business deductions, used in pursuit of obtaining that income. So, deducting things like, your cat's health insurance and so on. No, that doesn't qualify as an ordinary necessary business expense. But again, you would have your income or your total dollars you brought in through your business, your reasonable deductions, your ordinary and necessary business deductions to earn that income that you've earned. So maybe, again, things like rent. All of us have computers now, so it's going to be an internet expense, or we're all using softwares and subscriptions in all of our businesses now. So the softwares and subscriptions that you use in your business, those are the types of things. And that'll help reduce it down. You get down to a net number. So from there, you're going to calculate your self-employment tax on there. And then I will show, all right, let's see. I have never shared a screen when I do this, so we're going to give this a whirl. I do not know if it's going to work. So we will see if we can share the screen without seeing. All right, let's see. I'm going to show you just a quick calculation. Nothing fancy, nothing magical and mystical here. Just want to show you basically what you have. All right. I am crossing my fingers. You guys can see this. Ooh, I think you might. Okay. This is just a basic example. So you have your net earnings for this. You've got your earnings here. All right. So this is your net number. This is your revenue less your expenses. This is the net number. So let's just say 50%. And then you are going to multiply that 50% by 92.35. And without getting into crazy minutia and explaining all kinds of and going off on a complete sideways tangent, when you get to deduct half of that self-employment against your income tax. So just keep that in mind. So you need to now determine, now you've 92.35% of that earnings is now your tax base. So your tax base in this particular example here is 46,175. So now you're going to take your tax base and you're going to multiply it by the 12.4%, then the 2.9%. And then in this particular example, if you had self-employment income of 50,000, you would be paying self-employment tax of $7,000, basic round up $65. Just remember that is just your self-employment tax. You now still have 50,000 in income. And so there is going to be potentially an income tax. Again, if you've got standard deductions, and not going to go into that, but you potentially will pay income tax on that 50,000 as well. So where it gets scary for people in especially the first year of business, and they've never, let's see if that went down again. Yes, it did. Okay. And they've never had, and paid all of that. Your self-employment alone was $7,000. And then you're going to have income tax on top of that. That could be $3,000, $4,000, $5,000. So now suddenly you're in for $10,000 or $12,000. And if you haven't actually made any estimates, which we'll talk about estimates next week, if you haven't basically paid some money in throughout the year in order to cover that, or you haven't planned for it or saved for it, that's a really big number to overcome. So we're talking about estimates next week, but again, you want to realize that self-employment, you're on the hook for that, right? Now, like I said, you'll get to deduct some of it on your income tax return. I'm not going to dig into that. Won't want to bore everybody with that one, but I just want to make people aware that you've probably been paying self-employment tax. You know, you've been paying the dollar amount throughout the years, even when you work for other people. It's just now, instead of someone withholding that from your paycheck every week, every 2 weeks, every other week, twice a month, whatever it is, and doing that on your behalf, you actually still have to do that now yourself. And so that's where you really need to start to plan and think about where you're spending your money and really where you're saving and that's the reality of it. So some deadlines to think about. So when you are paying self-employment tax, so again, the deadline for a personal tax return would be April 15th. So that's when your tax would be due. If you are doing an extension, it's not an extension of time to pay, it's an extension of time to file. So keep in mind, your self-employment tax would be due on April 15, even if you weren't ready to file your tax return until October 15. A lot of times people get that confused. They think, oh, I've got more time, I can pay later. The reality is, no, you can't. You really should have paid on April 15th. And we'll talk about that another time, but it's just something to think about. That deadline is April 15th. So best way, or kind of some best ways to manage your self-employment tax is you have to keep accurate records and you have to keep them up to date. One of the things that we do for clients is on a quarterly basis, we run estimates for clients, right? And so we're running accurate estimates as accurate as we can possibly be based on what we know at that moment in time. So if we're coming upon an estimate date in the next week or two, so you would be calculating your estimates for the first 3 quarters of the year. You would want to have relatively accurate information to pull that off of. So if you don't keep accurate records and you don't keep them up to date, it's very hard to kind of run that and understand where you are. I do recommend that you, especially if you're paying self-employment tax, that you try to calculate it throughout the year, like 4 times a year for when the estimates are due, so that you are not surprised what the number is when you file that tax return, because no one wants to be surprised when they see that balance due, at the end. So again, accurate records and up to date. You've got to set the money aside and put it into a checking account, a savings account, however you choose to do it. I personally take a percentage of every dollar that I bring into this business goes into an account that pays my taxes. This is something we recommend most of our clients, if not all of our clients, to do, so that they are not surprised by that dollar amount at year end. We want all of our clients to be profitable. We want to get all our clients the tax deductions we can, but the reality is if you're good at what you do, you are profitable in your business, you will be paying tax. So you want to make sure that you are putting money to the side in order to pay that tax, because it can be a doozy at the end. And the other thing is that if you've never done anything like this before, especially when you get into business and now you're self-employed, I do recommend that you reach out to a tax advisor and you work with somebody, have them help you develop your estimates on a quarterly basis, have them help you with your tax return. You're eligible for more deductions when you have that business than you typically would be eligible for when you're just simply a W-2 with, little mortgage interest and real estate taxes on your tax return. You don't want to miss out on deductions. You don't want to miss out on tax credits and things. So when you get into a business, I absolutely recommend that you reach out to someone, ask your, fellow, all of us are in coaching and mastermind groups in our industries and our professions. So reach out to your colleagues and ask them who they use. Getting a referral through a colleague is typically the best way to do it. And so, yeah, just get the tax help. It really, it will benefit you. It can get costly sometimes if you try to do a little more costly than you think if you try and do it yourself. Again, if you have any questions, keep dropping them in the chat. We'd love to answer them for you. So again, self-employment tax, if you are not in an employer-employee relationship, any income that you earn is considered self-employment income, and any net income, revenue less expenses, that net number is subject to the self-employment tax, which is 15.3%. So just a real quick recap on, what self-employment tax is. Again, it's your responsibility to manage that number, to maintain it, to keep accurate records so that you can, in fact, calculate what that number would be. So that's on you as the business owner. So something to think about. You want to definitely keep track of your records and keep them in whatever way that you can, whatever best way that makes sense for you. Your record keeping ways may be different than mine, but again, you need to do what works for you. And again, if you like what we have, what we've talked about today or we've talked about in previous weeks, please feel free to join us every Friday morning at 10 a.m. For the Construction CPA Coffee Cafe. And if you loved today's cafe, please remember to comment down below, ask any questions. We'd love to get back to you and, help out or point you in the right direction. And remember, we're dropping the hammer on cash flow problems so you can build things that matter. We'll see you next week and have a wonderful weekend.